Hi, this is Randy Finney with Right Side of the Chart, and this is a market update for Tuesday, September 18th, 2018. It is the second market update. I put one out right after the open today, and I wanted to do one more as we head into the final hour of trading. It's 3:10 Eastern time right now, so about 50 minutes to go. This is the near-term chart. I'm not going to spend too much time. I've been hyper-focused on the near-term charts. I want to do something a little bit different and take a look at the bigger picture, dailies, weekly, and even just hit on a monthly chart. I want to show you guys. Haven't, I cover it from time to time, but there haven't been any significant developments out on the monthly time frame for months, if not years, actually. So, but there are some things to watch now. So we'll hit on that real quick. Now, before I leave the 15-minute chart behind, these are the levels I'm watching. I thought we'd get a reversal most likely here around 182.65 today, but we punched through it. And again, nothing really that has changed anything from the technical outlook of the market. This is a bounce back. This was the next resistance up here, 183.70. And you can see so far that's where we stopped. I referred to it as 183.70. I had the line there at 183.69. There you go. But that's pretty much what's capped the advance. So I put that on the side after we came through this level. I said, well, okay, well, there was a minor level I had about right here. And I said, this is the one I would put about 80% odds or so of a reversal there today. And so far, and that was when we were coming up here towards it. And that did stop the advance. And I gave some, targets for a quick pullback trade. Actually, I did that earlier today on this 1 minute chart of QQQ showing you this little wedge here, divergence. There's that 183.70 level. So that was a trading up, a day trading up. And again, if you trade NQ, that's a pretty nice trade there. It dropped about 0.5%. So that'd be, I think in NQs per contract, that'd probably be, if I'm not mistaken, about $750 or so. But again, even QQQ, SQQ, and that's active trading stuff. So let's talk about swing trading stuff. Let's get back to where it was. So that's that. Let's see what happens. But now let's get to the longer term charts. I already covered the short term stuff today, and again, not a lot has changed. We have reversed off that resistance level so far that I just showed you there. Daily chart. This is what stands out. This is just the technical picture. It's QQQ is continuing to. We broke down. We had a back test of a couple days right on the trend line, and we're still down below it so far. We also have an inside day. I pointed that out on the site. An inside day is when you have a candlestick that trades. The whole candle is within the previous day's candle. So that's what we have so far. It's an indecision candle. We'll see what happens there. Nothing really screaming. It's not like a screaming buy or sell signal. It's just something worth noting. And let's look now at the weekly chart. And again, a chart I've covered quite a bit recently. You can see all the divergent highs over the past decade. This is a 10-year chart. It encompasses the entire bull market. There's all your divergent highs in the past decade. And without fail, they were all followed by corrections, double-digit corrections, 10% or more. And except this one so far, even this little one here, you can see if you look underneath, you can see the little divergence line. So we had a small divergent high back earlier in the year, and that led to a 12% correction. I'm talking about the second drop we had. The first one we did have negative divergence on the 60-minute chart. I highlighted that all the way up, and right there, the day it broke, put out a post on the site. Sell signal confirmed on the U.S. equity markets, and we got that first swoon down. Covered on both. We were able to cover off the lows, but the bigger picture is this. This trend line, well defined. We're still above it, but again, these are big divergences building. And I would expect nothing less than a double-digit correction off the highs from the high, measured off the highs once this breaks. So again, I've talked about this earlier quite a bit. I think we're going to come before the end of the year. I think we'll revisit those lows back from January and March, the lows that we had there. So call it about 155, give or take. We'll see. And again, we need to see, as I've been saying, although QQQ has that back test, as does NQ. Let me show you. These are the Nasdaq futures on a daily chart. This is the same uptrend line right here. Comes off the early April lows, very well-defined trend line, and you can see that the futures broke down, back tested, and rolled off. We had another back test today at the highs, but we pulled back from there so far. Let's look at a couple other things. Remember now, the Nasdaq 100 is not the stock market. In fact, if there's one index that's the stock market or close to it, Well, the Wilshire counts too. That's very diversified, but the S&P 500, a much more diversified index. In fact, the Nasdaq is not, NDX is not very well diversified. 60% in technology stocks. So here's the S&P 500. I want to show you a different board. One second. Oh no, I had it marked up on SPY. Same thing, the tracking ETF. Again, I covered this morning. So there it is. SPY is still above trend right now, and so we need to see that go. We need to see the technology sector because I promised you that QQQ is not going anywhere without the tech sector coming along. These charts nearly perfectly mirror each other if you overlay QQQ and XLK. And like I always say, XLK or QQQ is like XLK with an Amazon kicker because Amazon's such a big weighting component, and you don't have Amazon here, but you have all the other, roughly the 60% of tech stocks that make up QQQ. So there it is. Need to see that go. Hasn't gone yet. If it goes, when it goes, I think it'll be pretty swift. I told you Amazon broke down yesterday. Well, we're going to get to the individual stocks in a second before we move away from here, and then I'll move on. Let's go to the long-term charts of the S&P, very long-term, and look at the bigger picture right now in the stock market. This is a monthly chart. These are year break lines. So this chart goes back all the way to, well, it goes back to the 70s, really. Let's zoom in a little bit here. Let's go back to the early 90s. So we'll encompass up until recently, this was the biggest bull market in history. Now this one takes the claim. However, there's a lot out there that dispute this. They claim this was one bull market up here to that area of consolidation was about a 2-year area of sideways consolidation or a deer market, which is neither a bull or bear markets when they trade sideways. And we did have, although the S&P didn't meet the technical definition of a bear market, meaning a drop of 20% from high to low, it came very close. But you had a lot of other indexes, small caps, mid caps, a lot of sectors that did. So again, whether you want to call that a bear market or not, it doesn't matter. It really doesn't. That's semantics. What matters is this chart going back again into the late 80s. I've shown you every single divergent high right here. This is RSI, negative divergence on the RSI, and you can see the biggest drops. This was a big drop back here in the early 90s, and it doesn't look like much on log scale. There's 20%. That was a bear market. There's another drop right there. That was the Asian contagion. If you guys were around back then trading or investing, that was about, I don't know, 20, 28, 30% almost. And there's their dot-com bubble at the highs to lows and 51% bear market. So again, you can see them down here. These are all the divergences, negative divergence. There's the stock market, bull market end in October 2007, followed by the Great Recession and bear market that took the S&P down about 55%, a little over. And again, divergence at the high. I haven't missed anything here. If I did, let me know. You can see a couple big corrections here. We had, what could have been, but there wasn't divergence right there. You can see at that point we did not have negative divergence. So again, the biggest drops here, or at least all those that had negative divergence, every period that had negative divergence going back for decades here was followed by a bear market, was followed by a drop of 20% or more. And when we look and we really zoom in here, we have a nice clean up trend line where you can see prices wedging with the divergence. There's the, market going on to make higher highs, and there's your divergence. So not confirmed yet, but getting close. Now I want to look at QQQ. I want to look at it on a weekly chart here. Which I think I just hit on this earlier, but I forgot, I neglected to mention that in my book you have a difference. And again, and I don't know if it's written in any other textbooks anywhere, but I consider divergence either potential or confirmed. Potential divergence to me is when you have prices moving higher on a security. And I'm referring to negative divergence. You can also do this with positive. You have prices moving higher, and then the indicators down below lagging behind or making lower highs. However, although the RSI, I don't use any type of signal line or EMA. Some people put it up there. You don't have that, but I like to use the PPO because you have a signal line. So in my book, confirmed divergence is when you get a bearish crossover on the PPO at lower levels. That would then confirm this recent peak right here. So there's your prior peak. So these are the lines that make up the divergence right here. And why did I do that? Because if the PPO is pointing up, the momentum is up, it's heading higher, and it could very well take out those divergences. So every time you have the PPO moving up, you have, again, if it's making lower highs, it's what I call potential, but I see it's confirmed, and it is very unusual. If we get this bearish crossover here, which is, I'll have to put up a histogram to tell you. Yeah, we're started so far this week, and this is a weekly chart. So by Friday, so pretty much any more weakness from here into the end of the week will confirm this bearish crossover that's in place now. Why am I just not? I'm not dismissing it now, but it's a weekly chart. These lines can cross, and sometimes they bounce. If you look back, there's a bounce right there. You can see a bounce that looked like we were going to get a bearish cross. There's a bounce that looked like we were going to get a bullish. There's a bounce that looked like we were going to get a bearish cross, but it didn't. The lines sometimes bounce. So we'll know again by the end of this week. And like I said, I don't even have to look at this histogram. I know if we close down anywhere from where we're at now or lower by the end of the week, we're going to have that bearish crossover. Whipsaw signals are possible, but look, it's pretty high probability. We get that divergence, we're probably going much lower. So I wanted to point that out. And then finally, like I often say, an index or a sector is simply a sum of its parts. So in the case of the NASDAQ 100, it's some of the, roughly 100 stocks. There's a little bit more than 100 in there. I think 103 total individual stocks. You have some with double symbols like Google, GOGL, and GOG. So call it 100 stocks either way. But what I wanted to get at here is let's take a look at, we'll just look at the top five because that makes up a good bulk of the returns. There's such top heavy weighting. And so we'll look here at Apple, the largest component of the NASDAQ 100, the largest component of the S&P 500, the largest stock in the world measured by market cap. So here's something I pointed out recently, and I pointed this out on a couple stocks. We had a bearish engulfing candlestick, and these are pretty high probability candlesticks. So there it is. You have a bearish engulfing candle. So what you did is or Apple engulfed there was a doji the previous day, and that makes it even a little more bearish. So you have when you have the body of one candle completely engulf the previous body, that's a engulfing candlestick. They can be bullish if they come at the end of if it's a big green candle after a prolonged downtrend, or in this case, bearish. And what I like to see on that is follow through. So we had that. We had 1, 2, 3 red days. In fact, there were in the following days, we had two other bearish reversal candlestick patterns. There were 3 days. A couple of those I covered. So the following candles also were their own bearish reversal patterns in themselves. But I wanted to point out here, we go back in time, and at just quick glance, I can see here was a pretty strong uptrend off that initial correction into the February lows. We rallied from there, pretty strong rally, about 22%. And as you can see, we'll zoom it in here a little bit for you. I think you know where I'm going. You can see another bearish engulfing candle that came at the end of that uptrend right here. And that was followed by a drop from highs to low. If I clip the top of that candle, before all was said and done, Apple dropped about 12.5%. So I look for those, and we have that in Apple. I'll show you a few more. We'll look at a couple other components, and then we'll wrap this video up. Here is Amazon. Amazon, uh, like I said, Amazon broke trend yesterday for the first time in a while, and I even moved this trend line out. I had it up here tight, and I moved it out to make it what I call the benefit of the doubt trend line. I captured that reaction low right there. There's a reaction low there. I'm talking about the candlestick wicks, the little tails there, reaction there and reaction there. So we broke it, but and I moved that line. I got to tighten it right up onto the bottom of that one. So we're back testing it right now. And again, Amazon's not going to break down and go down 5-10% without the QQQ going down, or the Qs in the rest of those stocks. Money flows in and out of QQQ, and it's, although not impossible, very unusual to see the big components go down considerably with the index just continuing to chug along. And as I also said, get used to some whipsaw signals here over the next couple weeks as the S&P does that first major sector rebalancing in decades. And Amazon's one of them. They're all being moved around into different new sectors. So by the end of the month, all the sectors in the S&P 500 will be different, and the components within those sectors. I shouldn't say all of them, but they're making some changes. They're eliminating telecom and moving things around. So and Amazon's going to have a lot of changes. So that may lead to some whipsaw signals is all I'm trying to get at, because as the ETFs and mutual funds have to sell and buy shares to meet the new rebalancings, and they also a lot of them are starting to do so in advance. But again, that's going to continue over the next couple weeks. And then of course we're heading into earnings season too. So you talk about volatility. All right, so there's Amazon so far flirting with the trend line on a back test after breaking down yesterday. Let's look at a couple more and then we can wrap it up. Microsoft, bearish engulfing candle, engulfed that doji the other day, just 2 days ago actually. So that was Fridays. We had a doji followed by a red candle that engulfed the body of that doji, that thin body there. And so far, not a lot of follow through. Well, no follow through because we're up today. But you can see these candles are almost equal. This one, the bottom was a little bit lower than Friday's candle. The top is a little bit below the top of that candle so far. Let's try not to read too much into that, but it would help to see some additional downside in Microsoft soon. Here was a bearish engulfing candle right there, and from that point, Microsoft fell about 5%. And remember, there's not a lot of corrections to go off of here. When I go on these charts, this has been one of the strongest runs leading up to those highs in January that we had in decades. So there was another bearish engulfing, came after an uptrend, 10.35% drop right there. So you get the picture. They're fairly reliable, but you want to see it prices remain above this candle that we had on Monday, yesterday's candle, and ideally you don't want to see a green candle follow up, but you just, yeah, like I said, the main thing is you don't see it take out that bearish engulfing candle. So Microsoft's close, not there yet. In fact, I covered this one recently on the 60-minute. Yeah, right here when we had this divergent high. We so far fell just shy of that first target, had a little kickback rally, and here's a minor trend line that it broke down below. So maybe another thrust down here soon in Microsoft. You can see the divergences have also been extended here. If you do this, take that divergence line right there and extend it out. And so we simply have just divergent high 1, divergent high 2 so far. Here's Alphabet, symbol GOOG, the Class A shares. And let's get rid of all those trend lines for a second. Just look again, focus on recent candlesticks. So this one topped, well, this along with Facebook topped a little while ago. We had a top back here so far back in July 27th. And that was a big, clean, beautiful bearish engulfing candle. You can see that. Right there, it engulfed the previous three candles right there. It was followed up with two red confirming candles to the downside, and so far the stock, hasn't looked back. It's that was the top right there, and from this point, from that high so far, Alphabet is down. Well, into yesterday's lows, it was down about 10.14% off that top. So there was a bearish engulfing. We can see here we had a nice uptrend off the February lows, bearish engulfing candle right there, followed by a drop of about 16.5%. Right here we had a candlestick reversal pattern. That's called an island cluster top. You had a cluster of candlesticks right here, separated with a little gap right here. There's a small gap there and a big gap right there. And that island cluster top resulted in a drop, or was followed by a drop of 18%. So there it is. That's the top components. We can look at Facebook. Facebook peaked a while ago. Again, had that big earnings disappointment. Not that it wasn't priced into the charts. I'd covered that in advance. We had a big divergent high right there, negative divergence, steep trend line, which Facebook broke down here and back tested for a while. Sometimes these back tests will try your patience, but very often they play out. And then it played out with that earnings induced gap and hasn't looked back since. So there's another top component of the QQQ that has topped a while ago and it's already down almost 28%. Divergence forming, but it's been building this divergence for a while, and I pointed this out in some recent videos. I'm looking at stocks like Facebook and Intel, some market leading stocks that have these divergent lows, and usually in a bull market, and this has been the trend for years now, you get these divergences on the daily time frame. They don't last long. It's like it's like the iPhone 10 or going on sale for $500. It's going to be sold out quickly, as quick as people find out about it. That's been my experience with these stocks. Um, Market leading stocks, it's rare to see these bullish divergent lows. And so what I'm getting at is we had it there and it didn't play out, and I'm moving these lines. We still have it right now. There was divergence there, barely. We have about equal lows right now. So the buyers just aren't stepping in, and that's not really what we've seen over the last few years. It's more indicative of late stage bull market action. Intel's up today, and I've showed this one here, but there's another one. I've been tracking this divergent low for a while. We've had bullish divergence from this point. We had it here on the daily. We had it here. Well, now we have it here. But that's no surprise to me. I mean, you can see this one could pop any day now, so take it as a trade idea if you want. There's your downtrend line, there's your wedge. I pointed out this divergent high here in this wedge, and I also pointed out in a lot of the videos back then, when we were up here at the highs, I was calling for a 24% correction. I still am. So that's where I think what's happening with Intel. The charts are playing out. It's not playing out on the majority of market leading stocks yet, but it's playing out on some. And that tells me that, we may be very close or already have seen a top, at least a significant top before a correction in the market. Yeah, so Intel, my target down here was about 45.60, and that's again calling for way back here, 24% drop. We're almost there, and that's my minimum target, by the way. I still think we eventually come down here. We'll get maybe reaction soon off that level. Maybe these divergences play out. We came very close, get a little pop, but ultimately, and probably by the end of the year, I think we come down here. And that'll be 32%. I can't remember if that's from the highs or where I started calling for that correction. Yeah, about there, roughly. And again, very clean trend lines, wedges, divergences, everything I just pointed out on the index chart. This to me looks just like that QQQ chart where I pointed out the 10-year chart of QQQ, where I pointed out all the divergent highs over the past decade. Here's a decade weekly chart on Intel. And the only difference is the corrections are a little bit larger in scope because this is an individual stock. It's a semiconductor stock. So there it is. Um, let's wrap it up here. I'll keep updated anything I see right now. Like I said, everything is priced in the charts. I think we're ready to go. I think it can happen and will happen very quickly once things do break. Once those levels I pointed out on XLK, the tech ETF. I think I hit on that again in this video. If I didn't, that's one of the key ones. And of course the S&P 500, SPY. See those break, and I think we'll start to see the selling accelerate to the downside and see some of these targets get hit. And XLK looking at if we come and test those lows from January and February in the tech sector from where we're at now, that's about a 16% drop. So I think it's worth trading, and you just have to have your ducks in a row ready to go when it breaks. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.